Hey guys, it's Adrian here, the Canadian in a t-shirt, and today, in honor of the 4th of July, I'll be breaking down the best US dividend stocks to invest in 2020 during the current market crash and beyond. In this video, I'm only going to be talking about dividend stocks in the United States. In fact, all of the stocks in this video are traded on the New York Stock Exchange. I've already made a few videos of my favorite Canadian dividend stocks, so check those out as well. I picked these stocks because they all pay a generous dividend, they have a long history of increasing their dividends, they are staples of the economy, so they will continue to earn money even during a market crash and recession, and I picked these stocks from different industries, giving you a diversified portfolio of the US market. These are stocks that you can hold onto for life and collect that passive income every quarter, and you can expect these dividends to increase year after year. And now is an especially great time to buy these stocks at a significant discount. Make sure you check out my last video on how to invest during a stock market crash. So click the pop-up at the top right to check out that video first before you jump into investing. Basically, now is not the time to panic and sell stocks. It is an incredible opportunity to buy these top quality stocks at a huge discount, but before you put a single dollar in the stock market right now, make sure you have enough saved up in your emergency fund, especially if you're worried about having your income reduced or even losing your job in these next few months. Also, in this video, I'm going to be breaking down exactly why I think these stocks are great choices. So I'll be talking about things like dividends versus capital appreciation, the payout ratio, and the amount required to qualify for a DRIP. If you need a refresher on these basics of dividends, then click the pop-up at the top right to check out my playlist, The Dividend Investing Guide. So watch those videos first and then come back to this video. So without further ado, let's jump into the best US dividend stocks to buy in 2020. Let's start with an industry which always performs well, even during a recession, and that's utilities. My favorite utility stock in the US is Duke Energy, ticker symbol DUK. Duke is one of the largest utility companies in the United States, and they provide the transmission and distribution of electricity and natural gas to millions of homes and buildings. This is a great dividend player because no matter what is happening in the world, whether it's an economic boom or a recession, people will always need their electricity and gas. So a company like Duke will always be profitable and will continue to pay consistent and increasing dividends year after year. Duke sells most of its energy out as regulated long-term contracts, so it has guaranteed locked-in revenue for years to come, and with that, you can count on its dividend. Duke is currently paying a great dividend of 4.62% paid out every quarter. The price of Duke stock dropped quite a bit by around 20% since March, so you can buy it for a great discount. And even when its price returns to normal, Duke still pays out a great dividend yield of around 4%. One of the best things about Duke Energy is its consistency. This company has been around for over 100 years, and with its long-term contracts, you can count on that passive income through its dividends. Even with such a high dividend, Duke still has a solid payout ratio of 73%, which is significantly lower than a lot of the other big utility stocks. That means that only 73% of its profits go out to investors, leaving 27% of its net income to reinvest in itself and grow. That money is going towards expanding its operations, but also to grow its renewable energy division in solar and wind power. This means that Duke can definitely sustain its current dividend and even afford to increase its dividend. In fact, Duke Energy has increased its dividend every single year for the past 10 years, which is exactly what you want out of a long-term dividend stock, especially during a market crash. Also, because of the reduced share price, it's now easier than ever to qualify for a DRIP with Duke Energy. Remember, a DRIP allows you to reinvest your dividend and use it to buy an extra share of a company rather than receiving it as cash. And the best part is, you don't pay any commission at all when you use a DRIP to buy extra shares. This is the best way to invest in the long term, allowing your dividends to compound automatically, giving you true exponential growth. In the case of Duke, you only need $7,100 right now to qualify for a DRIP. Let's go through the math. With a dividend yield of 4.62%, our $7,100 investment would give us $328 a year in dividends or $82 every quarter. Duke currently has a share price of $81.84. So every 3 months, our dividends will allow us to purchase a new share of Duke for free, and then we receive the remaining 16 cents as cash. Remember, this DRIP amount of $7,100 is lower than usual because the share price of Duke is so low right now. Once Duke stock recovers and returns to its normal price, the amount required to qualify for a DRIP will also increase. To find out how I calculated this number, click the pop-up at the top right to check out my DRIP video, where I go over the long-term benefits of DRIPs, and I provide a useful Excel spreadsheet that you can use to calculate the DRIP amount for any stock. Looking at the stock chart of Duke Energy over the past 10 years, you can see an overall upward trajectory with noticeable drops every few years. But after every drop, Duke is able to fully recover in a matter of months. With most utility stocks, I'm not expecting to see phenomenal capital appreciation. But with Duke, it's nice to see an overall upward trend, all while collecting those reliable dividends every step along the way. At number 2, we have a company which needs no introduction, Coca-Cola, with the ticker symbol KO. Coca-Cola is one of the largest companies in the world, and they own one of the most iconic and valuable brands of all time. Coke has been by far the most popular beverage in the world for over 130 years. This is the definition of a consumer staple. This is a product which will always be in demand, in good times or bad, in summer or winter. All around the world, humans consume 2 billion servings of Coke products every single day. It's hard to think of a brand more dominant or untouchable than Coca-Cola. But what about changing consumer preferences or the movement towards healthier options? Well, they sell way more than just Coke and Diet Coke. Coca-Cola owns over 500 brands of beverages, including Sprite, Fanta, Dasani, Smart Water, Minute Maid Orange Juice, Vitamin Water, coffee, Powerade, the list goes on and on. All of these drinks are sold in grocery stores all around the world. And on top of that, Coke has contracts with countless restaurants, including McDonald's, which is a great dividend stock in its own right. In the short term, Coke's revenue from these restaurants are taking a hit, which is why its stock price has dropped recently. But it's still incredibly profitable from the grocery store sales, which are open for business. Coke is currently paying a great dividend of 3.65%, paid out every quarter. The price of Coke stock dropped by around 25% since March, so now is an excellent opportunity to buy the stock at a huge discount and take advantage of that increased yield. Once the stock price returns to normal, its dividend yield will usually hover around the 3.2% range. Even with a higher dividend, Coca-Cola still has a solid payout ratio of 69%. That means that only 69% of its profits go out as dividends, leaving it with 31% of its net income to grow as a company. Coke does this by acquiring new brands like Costa Coffee, and more recently by reshaping its bottling operations to significantly reduce costs. With a safe payout ratio, Coke can definitely sustain its dividend and continue to increase its dividend year after year. Coca-Cola has actually increased its dividend every single year for the past 57 years, making it a dividend king. A common dividend strategy is to invest in dividend aristocrats. Those are companies which have increased their dividend for 25 consecutive years. A dividend king is one step further. You would have to increase your dividend every single year for 50 years straight. That's incredible and very, very rare. In fact, there are only 28 dividend kings right now, and Coca-Cola is one of them. So how much do you need to invest in Coke to qualify for a DRIP? With a share price of $45 and a dividend yield of 3.65%, you'll need about $5,000 invested to qualify for a DRIP. Let's check it out. The 3.65% yield will give you $182 a year in dividends, or $45.62 every quarter. That's enough to buy yourself a free share of Coca-Cola every 3 months without paying any commission. Remember, once its share price returns to normal, you'll have to invest even more to qualify for a DRIP. Looking at the stock chart over the past 10 years, you can see a consistent upward climb. Sure, there are a few fluctuations, but it always recovers and reaches a new peak in a matter of months. This is a stock that you can hold for 20 or 30 years and then sell it for reliable capital gains, all while collecting that passive income year after year. At number 3, let's move on to the industrial sector with another dividend king, the 3M company, ticker symbol MMM. 3M is a manufacturing powerhouse with a massive lineup of products, including automotive equipment, electronics, traffic lights, building materials, medical equipment, and even stationery products like Post-it notes and Scotch tape. Notably, they're also a huge producer of personal protective equipment like face masks, so their products are always in high demand, especially in times like these. It's astounding just how diversified 3M is with their product lines. And they have been a market leader for so long and in so many sectors that this company will always be profitable. And so you can always rely on them to pay out a generous dividend and to increase their dividend year after year. 3M is currently paying out a dividend yield of 3.75% paid out every quarter. With the drop in stock price, this is one of the highest dividend yield that this company has ever had, so I am definitely taking advantage of this discounted price. Even with this high yield, 3M still has a solid payout ratio of 68%. So they pay out 68% of its profits to you through dividends, and they keep 32% to grow through researching new product lines or acquiring new brands. With a low payout ratio and reliable profits, 3M is able to increase their dividend every single year for 61 years straight. This 61-year streak puts 3M in the top 10 list of dividend kings. even ahead of Coca-Cola. That's amazing, and that's exactly what you want out of a dividend stock. Unlike the previous two stocks on this list, 3M has a pretty high share price of $157, and because of that, it's really difficult to qualify for a DRIP. To get a DRIP, you'll need to invest $16,750 in 3M stock. That's a lot of money, but let's go through the math. With a dividend yield of 3.75%, that gives you $628 a year in dividends, or $157 every quarter. That's enough to buy yourself a free share every 3 months. Don't worry, this doesn't mean that you need $16,000 to invest in 3M. It's just that you won't be able to get a DRIP, but you can still collect those dividends and reinvest them in other stocks or ETFs. Looking at the stock chart over the past 20 years, you can see a pretty consistent upward trend, with one big exception. The stock price peaked in 2018 and then fell. This was due to litigation involving two of its products, but with its enormous range of essential product lines, I have no doubt that 3M will recover soon. And in the meantime, I am happy to collect those increasing dividends and to buy more stock at this huge discount. I should note that for all of the stocks in this video, you should hold them in your tax-sheltered account to avoid paying taxes on the dividends and the capital gains when you sell. For the Canadians out there, hold these stocks in your RRSP, not in your TFSA. Holding these stocks in your TFSA will protect you from Canadian taxes. You won't pay any taxes on your capital gains, and you won't pay any Canadian taxes on your dividends. But you will be charged a 15% US withholding tax on these dividends because they're coming from American companies. The only way to avoid this US withholding tax is to hold these US stocks in your RRSP account. So for these stocks and other high-yield US dividend stocks and ETFs, make sure you hold them in your RRSP account to avoid all taxes. I go into more details on this 15% US withholding tax in my TFSA and RRSP videos, so check those out. And for my American audience, hold these dividend stocks in a tax-sheltered account like a Roth IRA. And at number 4, we have an absolute legend of the stock market, the Procter Gamble company, ticker symbol PG. Procter & Gamble is a historic dividend king, and for me, it is the absolute definition of a dividend growth stock. In fact, Procter & Gamble is the first stock I ever bought. I've never sold it, and I will hold on to the stock for the rest of my life. It's that secure. Procter & Gamble sells consumer staples, products that people use and need every day no matter what. That's why they're so reliable. They have a massive lineup of products, from cleaning products, hygiene, baby care, home care, and you use these products every day, even during quarantine. Things like laundry detergent, toothpaste, shampoo, deodorant, diapers, and toilet paper. Even if you don't know the name Procter & Gamble, you know these brands. Tide, Bounty, Old Spice, Tampax, Crest, Swiffer, Head & Shoulders, and the list goes on and on. No matter what is happening in the world, in good times or bad, people need these products every single day. So this company will always have consistent and reliable income, and that's why they're always profitable, they always pay a dividend, and they always increase their dividend year after year. Procter & Gamble is currently paying out a dividend yield of 2.62% paid out every quarter. The best thing about Procter & Gamble is their consistency. They are able to maintain this dividend with a payout ratio of 68%. Again, this means that 68% of its profits go out to investors, leaving it with 32% of its net income to develop new products and acquire new brands. Talking about consistency, Procter & Gamble has been around for over 180 years, and they have never missed a dividend payment in over 130 years, even through the World Wars and the Great Depression. On top of that, Procter & Gamble has increased their dividend every single year for 63 years in a row. That 63-year streak makes them tied for number 3 of the longest running Dividend Kings, even ahead of 3M and Coke. That's phenomenal. Similar to 3M, Procter & Gamble has a large share price of $120, so it takes a lot of money to qualify for a DRIP. In fact, you'll need to invest at least $18,350 to qualify for a DRIP. With a dividend yield of 2.62%, that amount invested would give you $480 a year in dividends, or $120 every quarter, enough to get you a free share every 3 months. Don't worry about trying to reach this DRIP amount. Invest what you can and collect those dividends as cash and reinvest them in other stocks or ETFs. Looking at the stock chart over the past 20 years, you can see a remarkably consistent upward trend. Whenever it does drop, it's able to fully recover in a matter of months and continue to climb. For me, Procter & Gamble is the poster child of a dividend growth stock. It pays a respectable and reliable dividend every 3 months, but it also continuously appreciates in value year after year, even during a market crash. If you hold the stock for 20 years, you'll be able to sell it for huge capital gains, all while collecting that passive income every step along the way. If you're not sure how to actually buy these stocks, click the pop-up at the top right to check out my Questrade tutorial on how to buy US stocks as a Canadian. You're buying US stocks, so you'll need to buy them in US dollars. And if you're investing more than $2,000 at once, I suggest using Norbert's Gambit to avoid paying currency conversion fees. You can use Norbert's Gambit to convert Canadian dollars into US dollars, or vice versa, without paying any conversion fees. This technique can save you a ton of money, so check out my video for a step-by-step guide on how to do it. And if you'd like to get started with Questrade, which is my favorite online broker, click my referral link in the box below, and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission free. That saves you $50, plus I'll get a small referral bonus as well. So there you have it. Those are my top 4 best US dividend stocks to invest in 2020, especially during this market crash. Duke Energy is a utility stock with a high yield and selling at a great discount. Coca-Cola is a dividend king selling at a huge discount and can qualify for a drip with only a small amount invested. 3M is an industrial stock, incredibly diversified and one of the longest running dividend kings. And Procter Gamble is a consumer staple dividend king with a perfect combination of passive income and capital growth potential. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube, and hit that bell icon to be notified about new videos every Thursday. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. Be sure to tune into my next video on the RESP, the Registered Education Savings Plan, to learn how to invest in an RESP and how to maximize the benefits for your child. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.